How good is a company at running its business? Does its performance seem to be getting better or worse? Is it making any money? How profitable is it compared with its competitors? All of these are very important questions can be answered by analyzing profitability ratios. Profitability ratios are a class of financial metrics that are used to assess a business' ability to generate earnings compared to its expenses and other relevant costs incurred during a specific period of time. For most of these ratios having a higher value relative to a competitor's ratio or relevant to the same ratio from a previous period indicates that the company is doing well. Net profit margin is a ratio or net profits to revenues for a company's or business segment, typically expressed as a percentage. Net profit margin shows how much of each dollar collected by a company as revenue translates into profits. Net margins vary from company to company, and certain ranges can be expected in certain industries, as similar business constraints exist in each distinct industry. Low profit margins doesn't necessarily equate to low profits. For example, Walmart has delivered high returns for its shareholders while operating on a net margin less than 5% annually. In fact, in the first quarter of 2016, Walmart profit margin was 2.66%. In contrast, a business with a very small operating budget, such as an independent contractor working as a freelance writer, has very small overhead, and the result, most of its revenues is tied to profits. However, although freelance writers may have a high profit margin, its annual profits may seem low when compared to multinational corporations such as Walmart. Universal net profit margin is 7.2%. That is, for every dollar of revenue that the company generates, it earns a profit at a little more than 7 cents. This may be about average for large corporations, but is well above the average for firms in business equipment industry. Return on asset, ROA, is an indicator of how profitable a company is relative to its total assets. ROA gives a manager, investors, or an analysis an idea of how efficient a company's management is using its assets to generate earnings. The ROA figures give investors an idea of how efficient the company is converting the money it invests into net income. The higher the ROI number, the better the company is earning more money on less investment. Universal earned about 15% in 2016. This is a very healthy return and well above the average. As a rule of thumb, a company likes to maintain a high ROI as possible, and a higher the ROA, the more profitable the company is. Okay, let's turn to the last set of common financial ratios, the common stock ratio. Valuation ratios, which is most commonly called a common stock ratio, are used because they are simple to calculate. Also, it gives a clear idea of the relationship between cost of an investment and the benefits of owning it. There are many valuation ratios used to determine the worth of investments and convert key bits of information about the company to a per share basis. Okay, let's turn to the first common stock ratio, the PE ratio, or the price earning ratio. It's the ratio for valuing a company that measures its current share price relative to its per share earnings. In essence, the price earning ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earning. This is why the PE is sometimes referred to as the price multiple, because it shows how much investors are willing to pay per dollar of earnings. If a company were currently trading at a multiple of, or PE of 20, the interpretation is that the investor is willing to pay $20 for a dollar of current earnings. Other things being equal, you would like to find stocks with a rising PE ratio because higher PE multiples usually translate into higher future stock prices and better returns to the stockholders. As you can see, a universal ratio here, PE ratio, is 18.36, which you'd want to compare this number to prior years, its competitors, and most importantly to their industry. Okay, let's turn to the last ratio here for common stock ratio, and actually the last ratio for all sections that we covered here. We're going to look at the dividend per share. DPS is the sum of declared dividends issued by a company for every ordinary share. Dividends per share is the total dividends paid out by business, including interim dividends, dividends by the number of outstanding of ordinary shares issued. Dividends per share is important because the number one goal of a company is to return the value to its shareholders. Investors receive value through dividend payments and the price of the stock itself, which is equal to the company's total expected future dividend payment. Therefore, a company's profits and the amount it pays out in dividend drive shareholders' value. I always like to purchase stock that has dividends. You can see you can take the annual dividends paid to the common stockholder, and you can divide the current number of common shares outstanding. And here you have 15.15. Now, sort of talked about this already here. Here's just really a wrap up when you were looking at the numbers. You know, the numbers are one thing coming out with them, but it's what trends or patterns do you see? What do the numbers mean? What do the numbers tell you about? Of course, you want to look at the historical ratio trends of the company. I call that time, you know, looking at 2015, 2016, 2017. You also, important is look at the industry because, you know, each industry is different. The number may look bad, but when you compare it to industry, it might be a good number. Also, you want to compare and evaluate how the company's performance, when you said the industry, you also want to compare it. Here it says 2 or 3 major competitors, but you know, one for your project here, you only have to do one. You wouldn't have to do 2 or 3. And I say one with the industry is going to be a good indication of what's going on with the company. But the point of going through these ratios, it's going to tell you a story about the company, and you know, would you want to purchase their stock, or if you were a lender, would you want to loan them money? That's it for this chapter. Have a great day.